In today's video, we'll explain why taxes skyrocket in retirement once you're past 65. Over my many years in the financial services industry, my company and I have helped clients avoid the tricky taxes that catch most retirees off guard. Look, taxes are one of the most challenging issues you'll face in retirement. The problem is, ignoring deduction opportunities can quickly lead to you overpaying in taxes, losing out on years of extra income and possibly years of freedom. Well, in today's video, I'm not only going to show you why taxes skyrocket after 65, but I'm also going to show you a few ways you can minimize your taxes. Let's get into the video. So I've got this chart from my financial planning software, and this is from an actual client that I'm updating his financial plan. And I was looking at, the tax forecast for the coming years, and this struck me for a couple of reasons. So first of all, you see this huge spike going from 10% to basically 28% after the age of 65. And so, you always kind of want to know what's going on, what's driving this. But the second thing that struck me is how often I actually see this. And that's what prompted me to want to make this video, because it's actually a pretty common occurrence. First things first, one thing that tends to happen after the age of 65 is that a lot of pensions are set to start at age 65. So of course, that's going to increase your taxable income. And then most people, their full retirement age is around 66 or maybe 67. And so again, your income is going to go up, and that's probably going to increase your taxes as well. And so those are kind of the baseline reasons why you see taxes spike after 65. But generally, those two reasons on their own aren't going to cause a spike like this. So what's going on here? Well, the first thing that you're going to notice is the withdrawal strategy. The most common withdrawal strategy is you first take from your taxable accounts. So that might be your savings accounts and then your taxable brokerage investment accounts. You draw those down for income to live off of. Then once those are depleted, you go to your tax deferred accounts. That's like your IRAs, your 401ks. And then finally, you would draw down your tax-free accounts. Usually that's going to give you the best outcome overall by following that kind of cadence. Not always, but generally that's the cadence you do want to follow. The problem is the way that most Americans save is that they tend to have the bulk of their savings in their retirement accounts, and they have very little savings in, let's say, a regular savings account or taxable brokerage accounts by the time they retire. So it might be skewed 95% 401k, 5% this other stuff. And that's one of the primary reasons you're getting this huge spike. And that's what happened in this situation. So let me go back to this chart, and I want to show you this person is retired already, and he has virtually no taxable income, and he's drawing down his savings accounts. What happens is for the first several years, he's in a low tax bracket because he doesn't really have much taxable income. Well, out there around age 65, because he has the same type of skew where the vast majority of his funds are in his IRA account, he's going to have to start taking funds from his IRA, and he needs quite a lot of funds from his IRA. And so that's where you see this initial massive spike, and then it goes up even further, and that's due to the taxable Social Security and some other things that we're going to talk about as well. And so like I said in the beginning of the video, this is a really common occurrence, and it's going to happen to a lot of people. So what's the solution, right? What can you do here? Well, the solution is you start saving more in a taxable brokerage account. If you've got a runway here of 3 to 5 years before your retirement, you're in a great position to start saving outside of your 401k. And so it's going to benefit you to run an analysis like this to see if that would help you avoid the kind of situation that I just showed you. Now, the second reason these taxes tend to spike after 65 is because of required minimum distributions. Let's say that you're in a situation where you're actually very evenly balanced as far as, how much you have in a brokerage account versus an IRA. Let's say you have a couple $1,000,000 in a brokerage account and you have a couple $1,000,000 in your IRA, and you're able to not even touch your retirement account for distributions. You've got plenty of money to live off of just from your regular outside accounts. Well, guess what? Even if that's the case and you don't need to tap your retirement accounts, Uncle Sam is going to want to get his. And there's no way to avoid this. You're going to have to start withdrawing from these accounts. They're called required minimum distributions. Right now, at age 72 and a half, you will start having to take a required minimum distribution every year, regardless of whether you need it or not. And then by 2033, you can actually wait until age 75. But regardless, you're still going to have to pay the piper. And this is going to cause a spike in your taxes, especially if you have quite a lot of money in those retirement accounts. So what's the solution? Well, the solution here is strategic Roth conversions prior to your required minimum distribution. So a great strategy is, okay, great, I don't need to live off my retirement accounts before my required minimum distribution age. I'm going to do Roth conversions every year, and I'm going to take out up to my current tax bracket. I'm going to drain down as much of my IRA or 401k as I can without going into the next tax bracket. Over 5 to 7 years, get a substantial amount of money into your Roth account, which you'll never pay taxes on again. So that's the solution, and you need to start planning early to see if that's right for you. Hopefully you can do enough of this where the value remaining in your retirement account is so low that the required minimum distributions aren't going to blow your taxes up. All right, number 3, increased income triggers additional taxes that you weren't even thinking about. So if you have pension income or annuity income, and then you've got retirement account withdrawals, these are going to increase taxes on your Social Security, and you're even going to have to pay more for your Medicare premiums. Once you go over a pretty minimal threshold, you're going to have to pay taxes on up to 85% of your Social Security income. Not only that, Medicare premiums are based on your income. And so if you're over a certain threshold, your Medicare premiums are going to get bumped up. And then finally, a big one that most people aren't thinking about is this net investment income tax. This is a surcharge on taxable income. So what's going on here is the net investment income tax is a 3.8% surtax that applies to certain types of investment income that is over a certain threshold. I'm talking about income from things like interest on your savings account, CDs, bonds, dividends, capital gains, rental income, any type of passive business income. Let's say you own a passive stake in some business. That's going to count for this net investment income tax. And then finally, even income from the sale of your primary residence. If you're over the exclusion amount, so a common example is you retire and you decide that you want to downsize. Well, a lot of, let's say, very fortunate individuals have had so much appreciation in the value of their homes that they're over the exclusion, and the amount over that is going to be taxed as capital gains. But you also might end up paying net investment income tax because it's so high. So something you really need to be aware of and plan for to the extent possible. So now you can see how after age 65, a combination of income from retirement account withdrawals, pensions, interest, capital gains are going to push you into higher tax brackets and hit you with unexpected taxes on things like Social Security, Medicare, or even force you to pay the net investment income tax surcharge. And that's why it's so important to, first of all, have a strategic savings and withdrawal strategy laid out. You need to be strategic about the timing of income and the types of income. So that means, for example, if you're retiring at the end of this year, and let's say that you have a lot of stock options built up and you want to diversify and sell those. Well, probably what you need to do is wait until the next year to sell those, because presumably your income is going to drop off a cliff because you're retired. And so you want to push that into the following year. And same thing goes to if you were selling a business or a rental property. Be strategic about your timing if you can. Be strategic about the types of income you have. In your regular brokerage accounts that are taxable, maybe use municipal bonds rather than taxable bonds, and that's going to decrease your taxable investment income, and it's going to help you when it comes to the net investment income tax. Be strategic about investment location, right? Certain assets go better in different account types. You need to think this through, and then you have to implement strategies like Roth conversions or strategies like 1031 exchanges for real estate, where that will allow you to defer taxes on the sale of an investment property. So there's a lot of levers you can pull to make sure you don't get in the situation where your taxes spike later on in retirement. You just have to do your planning in advance. Now, everyone's situation is different, which is why it makes a lot of sense to run a comprehensive plan so you can develop the strategy that works best for you. If you're retiring soon and you want a closer look at your situation, click the link to my website in the description below where you can book a complimentary call with me. Thanks for watching.